Welcome to Minding My Money Mondays, a common sense talk about money matters. I'm your host, Jared Rogers, back for another episode. In today's episode, we're going to talk about credit. More specifically, we're going to talk about credit scores. Have you ever wondered what makes up a credit score? Curious about how to raise your credit score? Well, we're going to talk about all those things and more right now, so let's get started. Consider this. If you were lending your own money to a friend, you'd probably want to make sure that you get paid back, right? You probably wonder, have they paid their past debts on time? How much debt do they already have? And who else they've approached for a loan? Well, credit scores help lenders answer these same questions every day, but through a mathematical formula. These scores make their lending decisions faster, safer, and more fair. So it's really important you understand how your credit activities and behaviors are considered when calculating your credit score. Your credit score is a big part of your financial identity. It can be the most important factor in determining whether you get a loan and how much it will cost you in the form of the interest rate you are charged. So the first thing to know is that your credit score is an actual number, the most common credit score being known as a FICO score. Your score helps lenders evaluate how much of a risk it is to lend you money. It simply shows how responsible or irresponsible you are with your finances. When your score is good, it can help you get access to lower rates, which enables you to borrow for both short-term emergencies and longer-term bigger ticket items. This is why falling behind on your mortgage payments, car loans, or credit card bills is not a wise move. In fact, doing any of these things could damage your future ability to borrow, like getting a home mortgage on your second home down the road, or another car loan once your current car has run its course. Having a bad credit score could cost you even more in the long run, and that's because you'll likely be charged a higher interest rate when given loans and credit cards. It's also important to know that bad credit can affect you in areas of your life that you wouldn't even expect. Take employers and landlords, for example. Many may look at your credit score to see if you'd be a responsible employee or tenant. Some car insurance companies may also see a direct relationship between your credit score and the likelihood of you being in an accident. So in certain states, this could mean that you're charged a lot more for insurance simply because of your credit score. So how do you build a good credit score or protect what you've already built? Let's look at what goes into a score and how much weight is given to each component by lenders, shall we? Credit scores focus on 5 key predictive categories based on what is contained in your credit history, also known as your credit report. Your payment history, which makes up a whopping 35% of your score, is the heaviest. How much you owe, or credit utilization, accounts for 30% of your score. How long you've had credit makes up another 15% of your score. If you recently sought new credit, also known as credit inquiries or hits, makes up 10% of your score. And lastly, the types of credit used, or your credit mix, makes up the final 10% of your score. Now that we know what makes up your credit score, let's dive a little deeper into each bucket. Payment history. Payment history goes for all of your bills on your credit report, not just your credit cards. This one's pretty big because it makes up a decent portion of your overall score. Creditors want to know that you pay on time, every time, even if it's just the minimum. And consistency goes a long way, so pay your bills when they're due and never skip payments. How much you owe. The second most important factor is how much you owe. It's a good rule of thumb to keep your total debt lower than the overall credit available to you. Basically, don't max out your cards. The lower the better. You see, if you get too close to your limit, creditors may think that you're biting off more than you can chew, or that you're supplementing your income with your credit. For example, let's say that you have a credit card with a $2,000 credit limit, but you've managed to charge up a balance of $1,500. Well, that's a 75% utilization rate, which doesn't really look too good to creditors. So whenever you can, try and keep your debt to credit ratio as low as possible. How long you've had credit. Creditors want to see that you've been managing credit for a long time. Your credit history shows how long you've been using credit, how you've handled that responsibility, and how responsible you've been over the long haul. Establishing a good long history means you're a pro at borrowing or managing money, and you're likely to repay what you borrow. If you've recently sought new credit, the next thing creditors want to know is what you've been up to lately. They'll look at recently opened accounts and where you've been inquiring about credit. Even if you're relatively new to credit or were just thinking about borrowing, creditors want to see who gave you credit and when. Also, applying for too much credit can be seen as a risk. Why? Because it looks like you're desperate for loans. Remember, for the banks, it's all about getting repaid. Take department stores, for instance. Doesn't it seem like they're always offering you X% off if you open up a credit card? Although it could save you some cash right there at the register, think about the possible long-term consequences of opening and paying for yet another account. That's how the creditors look at it, and that's how you should too. Types of credit used. Lastly, your score is affected by the mix of credit types you have. A good mix will span different types of credit, from a mortgage to credit cards to installment loans like car payments that are repaid over time. Having a good credit mix can help you improve your overall score. This is because it proves you have experience handling a variety of account types instead of having a lot of accounts in just one area. And as I mentioned under how much you owe, remember, when it comes to balances, lower is always better for your score. So now that you know what makes up your credit score, it's important to know that you should check your credit reports every so often. I mean, that's how your credit score is established in the first place. There are 3 national credit reporting bureaus that you should know: Experian, TransUnion, and Equifax. You should also know that you're entitled to a free credit report from each of them every year, which you can request from annualcreditreport.com. Annualcreditreport.com is a trustworthy and safe way to check your credit account and obtain your free annual credit file disclosure. They are maintained by Credit Source LLC, and they are sponsored by the 3 major credit bureaus: Experian, Equifax, and TransUnion. But you should know that only the reports themselves are free and that there is a fee to get your actual credit score. When you do get your credit reports, make sure you check them for accuracy and take care of any problems ASAP. You don't want any skeletons in your credit closet. In the end, the best thing you can do to keep your credit score healthy is to pay your mortgage, installment loans, and credit card bills on time. Also, be careful not to exceed your credit account limits, and make sure none of your accounts are behind or delinquent. Getting an account turned over to a collection agency can really hurt your credit score. If you take the steps outlined in this video, you can achieve a higher, healthier credit score. And that, my friend, is something that money simply just can't buy. If you have questions that you would like us to answer in a future episode, you can send them to questions@makemymoneymakesense.com. That's questions@makemymoneymakesense.com. And if you never want to miss another money-saving tip, simply hit subscribe below and click on the little bell icon, and you'll receive notifications every time a new video is posted. In our next episode, I'm going to talk about how to get an 800 plus credit score. And I should know because I have one. Don't believe me? This picture right here is from that free credit score they offer when you log into your credit card. And this picture right here is from another one. It doesn't really matter that they're not the same value because different agencies use different scoring models. But what does matter is they are both in the exceptional range. So tune in next time and I'll show you how to do this just like me. Well, kids, it's been fun. It's been real. I'm Jared Rogers, and until we meet again, let's all continue to mind my money, and I will see you all next Monday. Take care.